Hi again, everybody. In my last video, I showed how adding an annuity to a retirement income plan can potentially increase the probability of receiving your desired retirement income from 66% to 100%. That's a pretty compelling result. But I also left you with another idea. Nothing in life is free. Today, I want to explain what I meant. Here's a quick recap. Our example assumed a $1 million retirement portfolio, a first-year income goal of $50,000, with an annual inflation adjustment over a 30-year retirement. So what's the catch? It really comes down to two key trade-offs. The first is growth potential. When you add an annuity, you're gaining much greater confidence that your income will last. But you're also giving up some of the upside that comes from staying more invested in the stock market. For example, someone retiring in 1974 without an annuity finished their 30-year plan with nearly $196,000 of annual income, almost 4 times the original target. That's a fantastic outcome, but it didn't happen for everyone. The red dots show retirement plans that failed before 30 years because the portfolio ran out of money. A combination of poor market returns and high inflation earlier in retirement can be especially damaging. The 1970s are a perfect example, with inflation forcing retirees to significantly increase withdrawals just to maintain their purchasing power. Now compare that with the same 1974 retiree using an annuity. Their income after 30 years was lower, about $138,000. But there are no red dots. Why? Because some of the investment risk was transferred to the insurance company, reducing the portfolio's exposure to market swings and making the income plan much more reliable. The second trade-off involves inflation. In our first illustration, without an annuity, income increases dollar for dollar with inflation. In this example, though, the annuity's inflation adjustment is capped at 3% per year. If inflation stays at or below 3%, you're fully protected. But if inflation rises above that, your income increase is still limited to 3%. That matters during periods like the 1970s when inflation was much higher. Could you buy an annuity with full inflation protection? Absolutely. But your starting income would be lower. Once again, nothing in life is free. So what's the takeaway? Every retirement income strategy involves trade-offs. Higher income potential usually means taking on more risk. Greater certainty usually means giving up some upside. For most retirees, the biggest risk isn't missing out on the highest possible income. It's running out of income when they still need it. There are plenty of other ways to build retirement income without using an annuity, and we'll explore some of those in future videos. But one principle always holds true. Greater potential reward comes with greater risk. Thanks for watching, everybody. See you next time. If you'd like to discuss retirement income strategies or use of annuities in general educational terms, please contact us. Any discussion of your personal situation would be subject to a separate review of your circumstances and applicable advisory disclosures. All content presented is for educational purposes only and should not be construed as a solicitation or offer to sell securities or provide investment, tax, or legal advice. All examples are hypothetical, for illustrative purposes only, and are merely arithmetic calculations. They are not representative of the performance of any type of investment, security, or strategy offered by the firm. Past performance is not indicative of future results. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. They are based on assumptions and estimates that may not be accurate or applicable to your individual situation. Always consult with a qualified financial advisor before making any investment decisions. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure site, www.advisorinfo.sec.gov.